All right, so I was watching a YouTube video that was talking about modern money mechanics, and they explained fractional banking. And so my way of learning things is to share it. So I'm going to share it with you guys. The first thing we have to understand is that the purpose of this is to describe the basic process of money creation in fractional reserve banking system. So the United States government needs money. What they do is, they go to the Federal Reserve System to do so, okay? And so what the government does in order to get money from the Federal Reserve is they send paper bonds, fancy little paper bonds. They send bonds to the Federal Reserve, and then the Federal Reserve, in turn, sends them Federal Reserve notes, the green dollars that you guys call the dollar, but it's really just a Federal Reserve note or a floating rate note, okay? And so they send those notes back to the United States government, and then those FRNs are deposited into the bank account, a commercial bank account, in a Federal Reserve Bank. Okay, and this is the legal tender money that goes into the United States money supply so that you and I can have money. Yay. Okay, so this is how creation of money, this is how money is created, okay, through the Federal Reserve System. All right, so now the reality that we see here is that there's actually no paper that's actually being used, although there are promissory notes and we do have these types of things, but most of this stuff is going on online. It's electronic. It's, the computerization of everything, right? So you got to think about our online applications, how that's playing into this also, but that's not what we're going to talk about right now. So 3% of the United States U.S. money supply exists in physical money, only 3%. The other 97% is in computers. It is ones and zeros, my friend. So a government bond, right, is a debt instrument, right? It is evidence of a debt. We owe you something, right? So the Federal Reserve is essentially purchasing these government bonds, this debt, out of thin air. Why? Because they're just making up things, and the government is essentially promising, right? We're going to promise to pay this money back, right? But you're getting money, which is something of value, out of debt, which is kind of weird, right? That we're in a little bit of a conundrum. And so the question is, right, how does money, which is value, how do you create money out of value, out of debt? How do you get money out of debt? And so this is the brilliance of this system, right? This whole system, brilliant stuff. So these reserves can be used, right? And so when we say reserve, we're talking about the money that is in this bank account. It's in here, okay? So there's a specific amount from that loan, from the loan that the United States government gets from the Federal Reserve. There's a specific amount of that has to stay in the account as reserve, okay? And the specific amount is 10% of the loan, okay? So for example, if you get a loan for $10 billion, the United States government asks for a loan for $10 billion. So if it's a $10 billion loan, $1 billion of that has to be in the reserves to satisfy the requirement of the Federal Reserve system, okay? $9 billion of the original $10 billion, you would think is used to deposit or to be given out as loans. But that is not true. What they do is the $9 billion that they can loan out, instead of loaning out what they already have of the existing $10 billion, they just create a new $9 billion. That's it. Now, how in the fark do they do that? How do they make the loans? Well, they don't pay money out of the money that they receive as deposits. They don't pay out of that. What they do is, and this is where you guys come in, and I come in, they accept promissory notes. They accept promise to pay from the citizens of the United States in exchange for credits to the borrower's transaction accounts. So your contract, they accept them, and then that's how they make loans. They make loans off of your notes. And the crazy part is that you are giving them something of value, right? You're giving them something of value, and they call you the borrower, but really they are the borrowers. Yes. Now, how do we know that the bank is the borrowers? Like they're the ones borrowing, but they're calling you the borrowers? 12 U.S.C. 1431, powers and duties of the banks. Each federal home loan bank shall have power, subject to rules and regulations prescribed by the director, to borrow and give security. Therefore, and to pay interest thereon, to issue debentures, bonds, or other obligations upon such terms and conditions that the director may approve, and to do all things necessary for the carrying out of provisions of this chapter and all things incident thereto. So if they're borrowing and they're paying interest, you're giving them something of value, something that they should be considering. But do we get consideration? I don't know. The point being is that there's a demand for a loan, quote unquote, right? You are essentially loaning your own money to yourself, right? And they are purchasing your debt note, right? But they're not giving us any consideration for it, right? Because for some reason we are paying back something that belongs to us with interest, which is, I think, a part of the issue that we're dealing with. So, and then secondly, and because there's already a $10 billion deposit to satisfy the loan requirement. Essentially, this means that for every deposit that occurs, every single deposit that occurs on a bank, 9 times that is created. That essentially means that for every deposit that occurs in the banking system, 9 times of that is created out of thin air. 9 times can be created out of thin air. And if you want to know more about that, go ahead and look at the Fractional Reserve Banking Explained Modern Money Mechanics on the Constitution Report right here.